Hello, good evening. Hello.
Hi, Mr. How are you?
Right. Okay. Let me just. Okay. We can start with the class. So let's look at this question. I think it's you guys. You have the question papers for 20. Yeah, October, November 2024. So let's do the question for business taxation and see how far we'll go. Right, so let's start with the question. They say Golden Car Manufacturer is a South African resident company that specializes in the manufacture, purchase, and sale of small cars. GCM is based in Pretoria, where its manufacturing plant and head office is. GCM's year of assessment ends on the last day of February. All amounts exclude VAT unless otherwise stated or implied by legislation. All transactions are concluded with VAT vendors unless stated otherwise. GCM makes 70% taxable supplies and 30% non-taxable supplies. This one, when you are doing your VAT, question, if they bring it like this, if they say they make 70% taxable supplies and 30% non-taxable supplies. So it means when you claim your input tax on VAT, you don't claim 100%. It means you only claim 70% here. That's what it means when you are doing your VAT input. It means you only claim 70%. These other 30% non-taxable supplies, you don't claim it from SARS as input tax. Then they say GCM is registered as a category B VAT vendor. Right, then as the newly appointed tax manager of GCM, you are responsible for finalizing the taxable income of GCM for the 2024 year of assessment. The company's accountant has calculated the taxable income to be 19,500,000 on 29 February 2024. However, she has not taken the following information into account due to uncertainty regarding its treatment in the calculation for tax purposes. So which means our starting point is here. This where the accountant is arrived in terms of taxable income. This is going to be our starting point. And they also say she has not taken the following information, which means everything on the additional information is not taken into account to arrive at here. That's what the question means. So, like I always say, for tax purposes, you cannot read everything. Once you read the background of the company, when you go to notes and additional information, go to the question so that you see what are you supposed to do. So in our question, we are required to calculate the adjusted taxable income of Golden Car Manufacturer for the year of assessment ended 29 February. Start with the taxable income of 19,500,000 and adjust it for the transactions not taken into account. Right. So here you must not make it similar to Remember, there's a question that say start with the net profit, accounting net profit. This is different. I think I'll look for another question which requires us to start with the accounting net profit. So this one is just taxable income. So which means what the accountant did is he left out all this information because he was not sure how to treat them for tax purposes. So which means in our case, we're only going to adjust this 19,500,000. So I will look for another question where we start with the accounting profit so that you guys, you will see how do you adjust the accounting profit to arrive at the taxable income. Right, so for this question, it means we are still continuing with the taxable income. There is no adjusting of accounting profit here. We're still continuing with the taxable income. Right, let's look at what they say here. They say, provide reasons for the calculations only for the specified transactions and support the transaction with reference to the relevant section of the Income Tax Act number 58 of 1962 as indicated in brackets in the notes form. So this is where you just have to apply like section, if something applies to section 11A, then you have to indicate the section. So let's start with here. So which means we start with note number 1. Let's look at what note number 1 is saying. So note number 1 is trading stock. They say GCM had opening stock amounting to 1,750,000 at the beginning of the 2024 year of assessment. On 10 February 2024, GCM donated 2 small cars, each with a market value of 135,000 and a cost of 130,850 to an orphanage home registered as a public benefit organization to assist with their transportation needs. GCM received a Section 18A certificate for this donation. Then we should provide a reason. Then they say during the 2024 year of assessment, a total of 480 cars were sold at 140,000 each. Then so these are the sales. Remember how we treat sales. So these are going to be our sales. Then on 29 February 2024, 20 cars remained unsold with a cost of 132,000 each. So this is going to be our closing inventory. It's going to be our closing inventory. So we have our opening inventory, we have our sales, and we have our closing inventory. So our opening inventory is going to be 1,750,000. Then our sales is 480 times 140,000. That is going to be our sales. Then our closing inventory is going to be 132,000. But let's not forget to start with this taxable income that is provided there. So let's start with the taxable income that is provided. So we have our taxable income, the one that is provided, which is 19,500,000. Right, then we want the trading stock. on the trading stock, we have the opening one. We have opening stock. So opening stock, what are we going to do with the opening stock? So this one goes, I'm not sure about the subsection. Section 22. There is one with section 22 point, section 22 subsection 2. Yeah, it's opening inventory, which is 1,750,000. So opening inventory, we are going to deduct it. Am I correct? This one we deduct it. Then we go to closing inventory. So closing inventory is the one that falls under section 22, subsection 1. That's the closing inventory. So under our closing inventory, what are we going to check there? So let's check how much are we going to take under our closing inventory. So on closing inventory, they are saying 20 cars. So it's going to be 20 times 132,000. That is going to be our closing inventory. Then this one is going to be our sales. So closing inventory is going to be 20 times 132,000. How much are we going to have there? 20 times 132. 1, 2, 3, 1, 2, 3. It's going to be 2,640,000. Am I correct? What are we going to do with trading stock? Are we going to add or subtract?
Subtract.
Are we subtracting closing inventory or adding it? Remember, according to section 22, closing inventory they regard it as income in the business. It's not yet an expense. So this one we're going to add it back. We're going to add. So here always take note, we less opening inventory because it's expended, this one. Then we add closing inventory, the one that is still available. So closing inventory, we're not going to subtract, we're going to add it. So don't confuse opening and closing inventory. Then we also have sales. They say there is also sales there. How much is the sales? They say 480 cars at 140,000. So how much is it going to be? It's 480 times 140. 1, 2, 3, 1, 2, 3. 67,200,000. What are we going to do with the sales? Sales will increase our taxable income. Am I correct? Sales will increase our taxable income. So we are not going to put a bracket. Sales will increase our taxable income. So, which means here, we are left with one item here. We are left with the donation. What are we going to do with the donation? Anyone with an idea of what are we going to do with a donation? Donation, what do we do with the donation? They donated trading stock here. Remember, this donation was for trading stock. It's not money. So what are we going to do with that trading stock which they have donated? It still falls under section 22, this donation of trading stock. Anyone with an idea, what are we going to do with the donation of the trading stock? Section 22 says what? Anyone with an idea there?
You subtracted.
Are we going to subtract it or we are going to recoup? You do a recoupment. So this donation here, let me just try to put it. What you guys should look at is if a company is selling any trading stock and then they donate that trading stock, or that trading stock is taken by maybe the director for personal use, trading stock. As long as it is trading stock, you include it as recoupment at cost. Recoupment at cost. Then you now go and apply a deduction under section, as long as they received a section 18A certificate, then you will now deduct this donation at the last, as we normally do. But as long as the donation is for trading stock, you start by doing a recoupment of that trading stock. So which means here, we have to recoup this trading stock at cost, which is 130, 850. Then times 2 cars, times 2. That's the recoupment that we have. So you have to include section 22, subsection, what is it? Subsection 8. But if you don't know these subsections, at least you must know this one. It falls under which section? Even if you don't know the subsection, you should know the section that it falls under. Right, so which means this donation, we first recoup the donation, then we'll deduct that donation at the end of our answer. Right, so which means the donation of the trading stock is so which means we are going to recoup at cost. So it's 2 cars times times what? Times 130, 850. So it's going to be how much there? 130, 850 times 2. So it's going to be 1, 2, 3, 261. 261, 700. So a recoupment is just like a profit. So which means it's going to increase our taxable income, this recoupment of donated inventory. So here, this donation, they meet section 18A, but this recoupment at cost is going to be under section 22. So that's the recoupment. So every time when you have a donation of trading stock, you recoup it at cost. Any donation of trading stock, then it means you have to do a recoupment. It's either inventory that was taken by maybe the managing director for personal use. You have to do a recoupment of that inventory, as long as it is inventory. But if it is just a normal donation, like for cash donations, that's the one that we do at the end of our answer question. Right? I don't know if there's anyone there on this donation. Before we go to another transaction, that is number 2. So we're done with number 1. So which means we go to number 2. And always when you are doing your donation, look at this. They received a Section 18A certificate for this donation, which means you should uh, take that donation into account. But if they don't receive this one, you don't do anything with that donation. Right? Unless if there is anyone with a question, we can go to number 2. Number 2 is the warehouse. What happened to the warehouse? They say the board of directors of GCM approved the construction of a new warehouse to increase storage capacity. Construction began on 15 August 2023 and was completed on 20 February 2024 at a total cost of 8 million. GCM commenced operation in the new warehouse on 25 February 2024, at which time warehouses of a similar nature were valued at 8,500,000. What are we going to do with the warehouse? The warehouse is a building, am I correct? It's a commercial building. So we're going to use section, it's a commercial building. So we're going to use section 13 which is 5%. And we don't apportion. You see here, the warehouse was completed on 20 February at a total cost, and they started to use it on 25 February. You apply the full, you don't apportion anything that falls under this section. You don't apportion anything. So we're going to give 5% of the cost, not the market value. We're going to give 5% of the cost. Here we don't apportion. So that's there on the on the warehouse. The warehouse just a building, is a commercial building. Yes. It's used for, so this one is going to be the warehouse. So under the warehouse, we are going to have 8 million times 5%. So we're going to use section 13 quill. How much are we going to have there? It's going to be 5% of 8 million. So this one is going to be how much? 400,000.
400,000.
So we deduct this one. So that's all about the warehouse. I don't think there's anything here. We have
So
to do.
sorry, why are we subtracting the warehouse? I think I didn't get that.
Sorry?
No, I was asking why we're subtracting the 400,000. I think I
Okay.
didn't.
Or the
Yeah.
400,000.
Yes, I'm
It's
asking why we are subtracting it.
okay. Remember, this one is going to be um it's an it's it's an allowance, a capital allowance, like, which is going to reduce your taxable income. Remember what we are saying here, according to section this section, it means if you purchase or if you build like here a warehouse for 8 million, what SARS will do is they will reduce your taxable income by 5% of this amount every year. That's what you call capital allowance. It's just like depreciation. When we buy an asset, what do we do every year in our profit and loss? We charge depreciation as an expense. So that depreciation is going to reduce our profit. So the same applies to here. Whenever we buy an asset that is in use for business, then it means every year we need to reduce um, to claim the capital allowance from SARS, so that at the end of the day we pay less tax. We are going to pay less tax. I don't know if you get this the sense behind.
No, I do. No, yes, I do get you. Thank you.
Okay, so which means we have to subtract it. The reason why we are
Yes,
subtracting it,
I do
sorry.
understand that we do. Sorry, I was saying that I do understand that we subtract the like capital allowances. I do know that we subtract them. So that's why I was like, I didn't get why we're subtracting the 400,000. But now after you explained it to me, then I
Okay,
understand that
okay,
it
no, so you
it
got it
falls
now.
under the
Okay, no
capital
problem.
allowances. Yes, thank you.
Okay,
You can continue, sir.
so let's go. So which means we can go to number two. Number two is the purchase of computer server. Sorry. They say through global industry research, GCM identified a technological advanced computer server designed to support machine learning workloads with large memory and data storage capacity, which would greatly benefit GCM's operation. On 20 April 2023, GCM ordered an HPE a computer server from a supplier in Durban for 482,500. GCM incurred 20,000 in transport costs to deliver the computer server from Durban to Pretoria, and further incurred 15,000 for installation in GCM's offices. The computer server was put into operation on 1 May 2023. In terms of interpretation note 47, computer servers have a write-off period of 5 years. Right. What are we tested here on the computer server? Um,
Is it not the taxable capital gain? I don't know. Uh,
the taxable capital gain.
that we're going to add. No.
No, we didn't sell it. Remember, when you look at recoupment on equipments whatsoever, you look at they purchase it and sell it. That's when SARS will need a capital gain on it. But in this one, if you check
Okay.
from the top going down, we just purchase for this amount. Then we incurred
Mm-hmm.
20,000 transportation. Then there was installation cost of 15,000. So Then they now come here and say the computer saver was put into operation on 1 May, and in terms of interpretation note 47, computer saver had a write-off period of 5 years. Anyone who has an idea of, who can also check what do we do with this computer saver?
Do we subtract it as an assessed loss? I'm just throwing out ideas in my mind. Somebody else maybe can try.
Somebody
Out
else
of
who
out
can
of
try. We just want to see how do we treat this computer saver transaction? The computer saver. You see here, what you should look at, guys, here is this is a computer saver, and when they come here, it means this computer saver is going to have a write-off period of 5 years, which falls under section 11E. It's no more capital allowance. What do we call it? We call it wear and tear. Right. If it is wear and tear, then it means we apportion. Once you have the wear and tear, then it means you apportion. So which means this 1 May, we should look at 1 May to 29 February. How many months are there? Then we apportion. Another thing that you should look at is the purchase. This is the purchase price. The same way we do in accounting. If you look when you are doing your AIS 16 in accounting, when you purchase an asset, um, the cost of the asset is not the purchase price. It will include transport and include installation. So which means we should add this first, 482,500 plus 20,000 plus 15,000. Then we look at the write-off period of 5 years. Then we divide by 5 years. So it means it's going to be 482,500 plus transport of 20,000 plus 15,000 divided by 5 times how many months are there from 1 May 2023 to 28 February? We just subtract 2, so they are going to be 10. So it's going to be 10 times 10 over 12. So this is how we treat this one using section 11E, wear and tear. So that's how you treat this one. But if they could have now said they sold this for this much, then it means after you deduct the wear and tear, you have your tax value. Then from that tax value, then you look at how much did they sell the machine. Then the difference is now going to be your recoupment. But in our case, the machine was not sold. So which means we just claim this wear and tear. Remember, the main reason for this wear and tear is to reduce our taxable income. These are some of the things that we have. The main reason is when you claim this one, SARS will tax you less, which means by the time this machine is going to be not of much use, like it is depleted, then you can still be able to get a new one because you have been saving those capital allowances that you that were reducing your taxable income. Right, so let's look at what do we do on the computer saver here. Let's look at here. So in this computer saver, the first thing is to add all the amounts, which is 15,000. Just remember 15,000 plus 20,000. What is the other figure? Is there anyone with the question paper close? Let me just check. So The other figure is 482,500. So plus 482,500 divided by 5 times 10 over 12. So this computer server we're going to use is wear and tear. Section 11E. Yeah, section 11E, wear and tear. So that's why we apportion. Remember, all those which falls under section 11E, the general binding rule, we apportion all of them. So how much are we going to have at the end of the day there? If we add, we get 15,000 plus 20,000 plus 482,500, 517,500. Then we divide by 5 times 10 divided by 2. 1, 2, 3. 86,250. Am I correct there? Do we all get 86,250? Are we still together? Are you guys there? Do you all get 86,250? Right. Let's look now. If you are guys are fine with the purchase of the computer server. So the most important thing on the computer server is here. The server has a write-off of 5 years, and it's going to be apportioned. And you look at when was it brought into use, then you apportion. Then here you look at the cost. The cost of the server is going to include installation cost, is going to include the purchase price, is going to include the transport. So then you now apply your wear and tear, right? Unless if there is someone with a question on the server, let's go to the listing of the factory building. This one you need to, let's do this one together. Listing of factory building. GCM wanted to increase its production capacity and decided to lease a factory building from Fact Limited. Who is a leaser and who is a lessee here? Is GCM a leaser or a lessee? It's very important when you are doing your questions here. The first thing when you come to leasing is, who is the leaser and who is the lessee? Anyone who can pick who is the leaser here in the question? Are you guys there? Who is the leaser and who is the lessee? Those who are doing FAC, quickly tell us who is the leaser and who is the lessee here. You guys, you know this. Those who are doing FAC, you know.
UCM is a lessee, and then LTD is a leaser. Is a leaser.
Who is the leaser? LTD. Yes.
Yes.
So the lessee is GCM because it's the one who is leasing from. So the reason why I'm asking you that is I want to see, because remember there is a different in treatment when it comes to the lessee and when it comes to the leaser. So there's a different in treatment. So you should first know, are you dealing with the leaser or are you dealing with the leasee? So as you are dealing with GCM as the leasee and we are doing the tax calculation for GCM. So let's go and see what are they saying there. Then they say the lease agreement between GCM and Fact Limited. The date when the lease started is 1 June 2023. Then the lease term is 23 years with an option to renew for a further 3 years. So if there is an option to renew, whenever you are doing your stuff, you add the option to renew. So which means 23 plus 3 is going to be 26, right? Then rental income per month. This one is easy because you just look at the rental income for the current year of assessment. So which means you start from June until February, then you multiply by 50,000 per month. The rental is not a problem. Then let's look now at here, proposal improvement to the factory building, 1,500,000. Then a once-off payment over. So this one is the lease premium. The once payment. We all do this when we start to rent, even if a house or whatsoever. They will ask us like, if you want, you should put a deposit. So this is the lease premium of 55,000. So this is going to be the improvement. Then I want you guys to understand this list because this is one of the questions that will carry marks if it comes. The list, there's a lot of calculation. So you must understand how do you do the calculation so that you don't lose the marks. Right, so let's look at what next. I wanted to say it was discovered that improvement to the factory building were completed on 1 October. This date is also important. The reason being that when you share your lease, your lease improvement, you are going to share using the remaining lease term. So which means when we talk of the remaining lease term, when you share this 1,500,000, you are going to share it using the remaining lease term. And here again, according to section 11 F, it means the lease term, when you do your calculations, is going to be limited to 25 years. So even if in the question they say 30 years, then it means in your calculation, you are going to limit to 25 years according to section 11 F on the leasing and section 11 G. So which means you are going to limit to 25 years. Even if you have 30 years here, you are going to limit the lease term to 30 years in your calculation. So what I'm trying to say is this 1 October 2023 is very important because when you share this lease improvement, it means you are going to share it using the remaining lease term. So when we talk of the remaining lease term, we're talking of from when the improvement was completed, then going upwards, that's the remaining lease term. So that remaining lease term is the one that we divide by into this 1,500,000 to get a deduction for that year of assessment. I don't know if you guys understand what I'm here. I want you guys to understand this part because this always, if it comes, it will come exactly like this. Or if it is a discussion, you just have to explain what you are seeing here. They say they bring it as a discussion, which means the way I'm saying it is the way you have to answer it in your discussion question. Right. Then on this one, you are the lease premium, you are going to deduct in equivalent of 55,000 divided by the lease term. So in our case, we are going to divide by 25. Remember, we say we limit. According to section 11F and G, we limit the lease term to 25 years. Then the rental income is not a problem. We'll start from 1 June to 28 February. How many months are there? June, July, August, September, October, November, December, January, February. Is it not 9? So that one is going to be, the rental income is going to be 9 months. For 9 months, from 1 June to 20 February, it's going to be 9 months. So let's start with the rental income. Rental income falls under the general deduction formula. So rental income falls under the general deduction formula, which is section 11A. So that's the rental income. So which means here it's going to be 50,000 times 9. So let me put it this way so that it makes sense. Let me say the lease. Okay, so let me just put a heading so that everything for that lease will go there. So we can start with the rental. The rental that is paid. So it's a deduction that falls under section 11A. So we just come here and say rental. Then it falls under section 11A, the general deduction formula. So it's going to be 50,000 times 9. 9 times 5 is 45. So this one is going to be 450,000. Right, so that's the rental. Then we want the lease premium. So lease premium falls under section 11F. It's just a section for, you see what happens to text. If something does not fall under the general deduction formula, you may find that it's going to be deducted using another section. So this lease premium does not fall under the general deduction formula. Then we are going to use section 11F to deduct it. So section 11F is the one that says when it is a lease premium, you divide the once-off payment by the lease period. Then it's going to be 55,000 divided by 25. Then you look, there's something that we must do there. Then you look at the lease commence on 1 June. So we say it's 9 months. So you now have to multiply by 9 over 12 to give it to apportion for for the year of assessment. Then you apportion by 9/12 there. So that's there. So which means we are going to apportion by 9/12. So how much are we going to have there? It's 55,000 divided by 25 times 9 divided by 12. So the lease premium that is going to be deducted is going to be 1,650. 1,650. That's the deduction for the lease premium. Then the improvement. Then we need the leasehold improvement. Leasehold improvement. Let's go to the question again. So we're going to use section 11G. So on the leasehold improvement, we have 1,500,000. So what you are going to do is 1,500,000 you divide by the remaining lease period. So when we say the remaining, it means we start to count from November going onwards, from 1 October going onwards in our case here. That's the remaining lease term. So in this case, the remaining lease term, we are also working on 25 years. So let's just say from 1 June, that's when the lease commences. Then the remaining lease term is going to be how much? Until February, from October to February, October, November, December. No, we should count it from November, December, January, February. So we have to remove to say 24 years. It's going to be 24 years times it's going to be, let's say 25 years. I want to say 25 years times 12. How many months are we going to get there? 25 times 12.
You said 12 months.
Yeah, times 12 months. It's going to be
It's
300. Am I
288.
correct? That's the full. We did not remove anything. So we now remove the one from November, December, January, February. We are going to remove 3 months here, which is going to be 300 minus 4 is going to be 200 what? 296. Am I correct?
Yeah. I'm starting to get lost.
You're completely
But
lost.
continue. Yeah. But continue.
No, let's do it. Yeah. Anyone who get the sense, I want you guys to understand how do we apply the improvement. Is there anyone who understood how we apply the improvement? So
Guys, are you there?
so let me just put it together. What we are going to do is here. What we do is when you do the improvement to the factory building, remember it's going to be a deduction here. But SARS does not allow you to deduct 1,500,000. They will say you are going to deduct based, you apportion this to the remaining right. you apportion to the remaining lease term, which means this 1,500,000, you are going to divide it by the remaining lease term. Then what you have is what you are going to take as a deduction. I don't know if you guys get this, what I'm trying to say. So which means our remaining lease term will start from here. The building was completed on 1 October. So which means we start to count November, December, January, February. Then we are now on from 25 years. Then it means the remaining lease term is going to be reduced by those months. I don't know if we are together or we are still not together.
So okay, so we start to count from 1 October 2023 up until like when? Until June 2024 or 2020. That's where I'm getting lost.
Okay. So let's start here. When was the lease? When did the lease started? It started on 1 June, né?
Yes, 2023. Yes.
Right. So which means if you count here, it was discovered that the improvement to the factory building were completed on 1 October 2023 at a total cost of 2,500,000. So when we do our calculations now for the remaining, it means we are now counting from when the building was completed. That's the remaining lease term that we are now talking of. From when the building was completed. So which means we're starting from 1 October. You see what happens is we start from 1 October, then we complete our 2023, 2024 year of assessment. I don't know if we're together here.
Yes, now we're getting somewhere.
So that means we have completed 1 year there. So from our 25 years, it means we're now left with what?
24.
Yeah, 24 years. We're now left with 24 years. So what we now do is, the year we are in October now. For this year of assessment, we are now counting November, December, January, February. So which means now, from our 24 years, it means we are only left with 4 months to complete the year, which means we have used 8 months of the year. So in that case now, it means the remaining, we subtract from our year, we just subtract the 4. Then we now have the 296 months for the lease period. So that's basically how you calculate your leasing. So when you divide this by 296, that 296 now, it means you are going to get your allowance per month. Then you look at from 1 October to 28 February, how many months are there? Then you now multiply it by those number of months. Then you get your leasehold improvement deduction according to section 11, section 11G. So that's how you treat the leasehold improvement. So the leasehold improvement and the lease premium, here. This, you see how we treat the lease premium and how we treat the leasehold improvement. So which means this one is going to be 1,500,000. Then you divide by the remaining lease term. So it's going to be, we say it's how much? 296.
24.
Then
Then,
times,
the amount that we.
yeah,
Mhm.
times from October to February, how many months do we have? Times 5.
5 divide by 12.
So
That's it. Oh,
we divide this into here, then we multiply it by 5. I don't know if you guys understand how do you calculate this thing. I want you guys to understand this one because it's something that we can just come across. I'm getting anyone who got the figure there. I'm getting 25,383. So we can make it 25,338. So we're going to deduct this one for this current financial year. So this is how you treat, but there's something according to section. So this one is section, let me just put the section here. Section 11G. If you if you also want, you can check in our textbook on lease improvement. There's a very good explanation there in the textbook on lease improvement. If you want to update your a more understanding on it, because according to section 11G again, what are we going to do with this the cost? Because this guy is the compulsory improvement to the factory is 1,500,000, but they've completed it at a total cost of 2,500,000. So what are we going to do now? Anyone who pays still, I think we did something like this before. Yeah, there is an improvement of 1,500,000 that is compulsory, but they now complete at a total cost of 2,500,000. So what are we going to do? So which means now we are now going to apply section 13. It's an improvement to what? To the factory. So it's going to be, we are now going to apply section 13 to this one. So they will now claim the difference between 1,500,000 and 2,500,000 using section 13 queen. So that's how CGM is going to claim the difference. So which means that it also falls under the lease improvement. So this one is now going to be a capital allowance under section so they are going to claim the additional. So they use 2,500,000. So is term section 35%. We don't. So how much are we going to have there? Would be 1,500,000. It's 1 million. 1 million times 5%. 1, 2. So it's going to be 50,000 here. The capital allowance that we are going to have here. So what I can say here is every time when we have a question like this on your list, the compulsory improvement to the factory building is 1,500,000. This is where your leasehold improvement will come from. Then they will now come here and say it was completed, if the cost of completion is different from the compulsory, then it means the lessee can claim the difference under section 13 queen deduction. The difference between the compulsory and the total cost can be claimed under section 13 queen as a deduction. So that's basically what you do. So which means you should, on the risk improvement, you should check for the difference between the compulsory and the total cost that was incurred. I don't know if there is any question there before we go to number 5. If there's anyone with a question before we go to number 5. Any question before we go to number 5? I want you guys, if for now is we are still trying to figure out, I want you guys to understand this list. If you try to check it on your own when you have time, in our next class, just yes, there's someone.
Okay. Good evening, everyone. My question, I love more, is that if the compulsory improvement and then is completed at a lesser amount than 1.5, how do we treat it?
If the compulsory improvement to the factory building was completed, for an example, let's say here it was at a cost of 2,500,000. Let's say they say 1 million here.
Yes.
That one I'm not sure exactly, but let me say, I think in most cases they will stick to the compulsory. They will stick to the compulsory, but let's double check according to, I'll also check section 11. What does section 11G? Maybe something that we miss from section 11G. Just remind me also to check on section 11G. Because I don't want to say an assumption on it. I want to say something which is exactly. Because I've never come across it, but let us check on section 11G. I'll also check on section 11G to see if this amount is less, what is going to happen. So yeah, I'll also double check on that section 11G. But my assumption is they will stick to here, but we have to double check. So for now, that's what I can say, unless if there's any other question on this list. But for this one, I think we need also to check here to see if this amount is less, are we going to stick to this or are we going to stick to this? I think that's only what we need to check here. Okay, unless if there's another question, I think we have to go to number 5. If there's any other question, we can go to number 5.
Continue, sir. Thank you.
Sorry. Okay, so
I was saying you can continue with it.
Let's
Yes.
go to number 5, sale of the delivered van. What are we going to do there? They say on 31 August 2023, GCM sold one of its delivery vans to Able Drizzle for 120,000. On this date, the market value of the delivery van was 180,000. Able holds 25% of the issued share capital of GCM and serves as the managing director. The tax value of the delivery van was 2 million on 31 August 2023. What are we going to do with the sale of the delivery van? The sale of the delivery van. This delivery van was sold to the managing director. Anyone who has come across the treatment of the sale of the delivered fund. What do we consider here? What you should look at here is he holds 25% of the each share capital and is also the managing director. So what do you call this person? Is a connected person. That's the first thing that you need to. Any sale of anything to a connected person is suspicious when it comes to SARS tax. So if this guy is connected, then let's check what we have to calculate, because there is they sell it for 120 and the market value of the delivered van was 180 and the tax value of the delivered van was 200,000. So what I'm going to do there, right, when you have this, it means you have to calculate if there is recoupment or scrapping allowance. You have to calculate if there is recoupment or scrapping allowance. So which means if it is sold to a connected person, then it means here, this is going to be our selling price. We check the market value as the selling price. Then our tax value is here. So it's going to be like this. So this one is the sale of the delivered van. Right. So the sale of the delivered van, we need to determine if there is recoupment. So we are going to have the selling price as the market value. So which is going to be 180,000. Then we have what tax value. The tax value is 200,000. What are we going to have here? Are we going to have recoupment or scrapping allowance? Is it going to be a scrapping allowance or recoupment?
Scrapping
So this
allowance.
one is going to be a scrapping allowance of 20,000. Right. This scrapping allowance, what are we going to do? Allowance of 20,000. Right. When you look at this scrapping allowance, you look at here. Anyone who is holding more than 20 shares and is a connected person, it means you are now going to use section, because remember scrapping allowance falls under section 11(O). So there are those who are connected and they are holding more than 20% shares in the company. Whenever there is a scrapping allowance, then the deduction is not going to be allowed. It's going to be disallowed. So which means this scrapping allowance is not going to be allowed as a deduction. You can come here and say, what can we say? You can say section 11 or scrapping allowance. So the person hold, so this director hold more than 20% shares and is connected. So if he is like this, then there is no, you are not going to allow this scraping allowance as a deduction. So this one is going to be so there is no deduction for this scraping allowance. But if this person was not a connected person, then it means this 20,000 we're going to deduct it. So if you check on your section 11 or scraping allowance, there is what makes this a disallowed deduction. If someone is holding more than 20% shares and is connected, then it means you are not going to allow that as a deduction. So that's basically there. Then on number, so the sale of the delivered van is fine. Then let's go to the Wi-Fi contract. The Wi-Fi contract, GCM entered into a Wi-Fi contract with MTM, not MTN, whereby MTN provides GCM with uncapped Wi-Fi for a period of 7 years. The contract commenced on 2 May 2023, and the termination is, I think they wanted to say, the termination date is 30 April 2030. GCM is required to make an annual payment of 80,000 to MTM on 2 May of each year. Access to the uncapped Wi-Fi will be suspended if the full payment is not made on 2 May of each year. The first payment was made on 2 May 2023. What are we going to do with this one? The Wi-Fi contract. What are we tested? Remember here they are saying reference to the Income Tax Act. Which Income Tax Act are we tested on here? Any idea on the Income Tax? Because once you know the Income Tax Act that you are tested here, then you apply the Income Tax Act. Remember, even when you are answering your discussion question, this is how you do your, if you know the Tax Act, then it means when you discuss, you just discuss based on what that Income Tax Act says. So in our case here, what are we tested here on the Wi-Fi contract? Obvious, the 80,000 is going to be a deduction that falls under Section 11A. It's going to be a deduction that falls under Section 11A. But there is also something here, because if you check, the year of assessment is 28 February. So if we are paying every year on 2 May, the full amount until 28 February, what is going to happen? Are we not having a prepayment here?
Can you please repeat the question? You're saying if we pay from which month to which one?
We are paying
We have
from
a
2 May
prepayment.
to 28 February. From 2 May, the year end is 28 February, but they are paying from 2 May to 2 May every year.
Oh, yes, we have a prepayment of the months from
A prepayment
April to May.
of March and April, am I right?
Yeah.
Is it March and April? Yes. Right. So if we have a prepayment, what do we do? I think that's the only thing that we need to identify here. If we have a prepayment, then what do we do with the prepayment? You go to section, which section? Section is section 23H. Is it H? Yeah, section 23H on prepayment. So if you go to section 23H, it will now say, if it is a prepayment, for you to deduct that prepayment into the current year of assessment, it must be, I think you guys did this, even when we were doing 2601, we did. It must be less than 100,000. The amount must be less than 100,000. And the prepayment must be less than 6 months. So these are the two that you consider. If it meets any one of these, then you are going to deduct that prepayment in the current year of assessment. I don't know if we are together on section 23A. So every time when you meet a prepayment, you look at, is it less than 100,000, the amount? Is the prepayment less than 6 months? So if it meets any one of those conditions, then it means you are going to deduct it in the current year of assessment. But what is important now, remember, this prepayment, you are not going to deduct it under section 11A. You are going to deduct it under section 23H. So the first thing that you need to do is to split here. How much is going to be deducted under section 11A? Then when you split, the remaining one is the one that you are going to deduct under section 23H. Because if you just put everything under section 11A here, you get a mark, but you won't get a full mark. So which means here you need to split them. Right, let's see how do we split now. There is a prepayment of the Wi-Fi contract. So we have the Wi-Fi. So under the Wi-Fi contract, we should look at how much is the one that is we are going to deduct under section 11A is the one that falls within the current year of assessment. That's the one that we are going to deduct under section 11A, the one that falls under the current year of assessment. So it's going to be from the one that falls under the current year of assessment will be from May to February. How many months are we going to have there?
We're doing the prepayments too.
The one that falls, we subtract 2 from 12. So which means we're going to have 10 over 12. That's the one that falls under the general deduction. Yes. Am I correct? Are we together on that one? On the 10 over 12?
Yes, we're good. Yes, we're still following.
Okay. So this is the one that falls under the general deduction formula. So we are going to have how much there? $80,000 times 10 divided by 12. 1, 2, 3, 66,667. So we can make it 66,000. Right? So this is what goes under the general deduction formula. Then what goes under section 23, sorry, not G, is H, prepayment. So in this case, it means it's now going to be our 80,000 minus this one. But for you to be safe, especially in the exam, okay, let's have the figure first. So it's going to be 80,000 minus 66,667. How much are we going to have there?
333.
Right. So what do you do now? When you have your figure here, don't quickly bring it here. This is where you apply section 23H. Section 23H will now tell you that if this is less than
100,000.
yes, 100,000
No,
and
less than 6, and also less than 6 months. Yes.
So which means we are now going to deduct it. So if it was more than 100,000 and more than 6 months, it means we're not going to deduct it. So which means here, this one, we are now going to deduct it. Because if you don't show this statement, you did to someone who doesn't know, you did not tell us the reason why you deduct this amount according to section 23H. Because section 23H will say you only deduct if something is less than 100,000 and less than 6 months. If it meets any one of the criteria, it doesn't have to meet all of them. If it has to meet any one of them, then it means you have to deduct that amount in the current year of assessment. But if then it means it has to fall into the next current year of assessment. Right? I don't know if there's anyone with a question on the Wi-Fi contract. On the Wi-Fi contract, you just need to understand what goes to section 11A, what goes to section 1123H, prepayment. So that's basically how you apply.
Are we also?
Yes.
Sorry. No, I was going to say, do they also award, meant to say award marks for us showing the calculations and how we got to the specific answer?
You mean how you the calculation? Yeah, you see when they mark these people,
Yeah.
they will give you a mark for year, and there will be also, but sometimes you find, you see how they do. Sometimes you may find that there is a mark for year, and there is no mark here. It depends on how many marks that the question here. Sometimes they will bring a mark to this side in most cases. But if the question is, if this line is 2 marks, it means they will bring a mark here and here. But if it is 1 mark, they will bring a mark here on your calculation.
Okay.
Right. Unless if there is someone with a question on the Wi-Fi contract, then let's look at what next. What next? What next there? So there is the manufacturing machine. That's the last there. Then they say GCM purchased a new manufacturing machine on 1 July 2022 for 800,000, and it was brought into use on 6 July 2022. On 31 January 2024, a heavy storm destroyed the machine. GCM insurer made an insurance payout of 805, including VAT, for the damaged machine. On 15 February 2024, GCM replaced the destroyed machine with a new manufacturing machine costing 850,000, which was brought into use on 20 February. What are we tested on the manufacturing machine? The machine was destroyed by the heavy storm, and these guys, they got an insurance payout here. So what I'm going to do with the manufacturing machine, anyone with an idea of this manufacturing machine? What are we going to do with the manufacturing machine? Are you guys there? What are we going to do with the manufacturing machine? There was a machine, yes.
No, I say we are here, but we're still trying to think about it, and it's not
Yeah,
coming.
you guys, by now you should know these things by head. By this time, try by all, you see, try by all means so that the moment you read the question, quickly straight to the answer. The good thing about what I like about text is most of its stuff is just revolving. If you know, the moment you read this question, like when I'm reading this question, you can see the machine was purchased new here for 800,000. Then it was destroyed by a storm. Then there was an insurance payout. What do you think SARS means here? Remember, we are doing calculating the taxable income. If you get money from somewhere, SARS obvious, they want to see if you made a profit there. Did you gain from that 805 that you received from insurance payout? So which means what you do now is you need to calculate the tax value of this machine, the manufacturing machine. Then you now compare the tax value with the insurance payout. Then you see if there is a recoupment or a scrapping allowance there. That's all what SARS do. They want to check if they can get something out of it. So which means we need to calculate the tax value of the destroyed machine. Then when we calculate the tax value of the destroyed machine, we compare with the insurance payout, which is just like the selling price. The insurance payout is just like the selling price. The difference between the two will tell us if there is a recoupment. And if there is a recoupment, another statement is involuntary. This one is an involuntary sale. They did not they did not lose this machine voluntarily. So it's an involuntary sale. So which means we are now going to apply section 8(4). In section 8(4) now, if there is a recoupment, then it means you are not going to take into account the full amount of the recoupment as income. You take the amount of the capital allowance of the incoming machine. Like you can see here, they just replaced the old machine with the new machine. So the new machine is going to be having a capital allowance of 40%. Remember, it's new. So which means the recoupment that you are going to include, you only include 40% of the recoupment. So that's basically how you treat when you have this kind of a question. So let's try to see how do we put it on paper. It's the manufacturing machine. So on the manufacturing machine, what we need to first is the cost. Then we subtract the capital allowance to arrive at the tax value. So we need the cost. They say how much was the cost? It's 800,000. Right? Then from the cost, we need to check the capital allowance. This machine was bought on 1 July. So which means it has 2023 and it was destroyed on 1 January, on 31 January. So we have 2023 and 2024. So those are the 2 years for the capital allowance. Remember when you do your capital allowance for a manufacturing machine under section, which section again? This company is not a small business corporation. So you use section 12E. When you do your capital allowance, if the machine is new, you start by 40 in the first year, then 20 in the second year, and third year going forward. So which means we are going to have capital allowance for 2023. 2023 allowance is going to be 800,000 times 40. So you are using section 12E here. How much are we going to have there? Times 40. It's going to be how much? 1, 2, 3. 320,000. So that's the capital allowance for 2023. Then the one for 2024 is going to be 20%, which is 800,000 times 20%. We're still using section 12E. How much are we going to get there? So this one is going to be half of this. It's going to be 160,000. Right? So what are we going to have after here? What is the figure that we need here? After we subtract the capital allowance, what is the figure that we are going to have there? What are we going to have here? It's a what? This is going to be our tax value. This is the tax value. So our tax value is going to be 320,000 here. What do we do with the tax value? We compare it with the payout. So the payout is 805, including VAT. So it's going to be 805, excluding 805,000, excluding VAT. It's going to be times 50. It's not times 15. It's times 100 over 115. How much are we going to have there? So it's going to be 100 divided by 115 times 805,000. How much is it going to be the payout? 6911. So we can get it is 700,000. Yeah, we can put it as 700,000 here. So this is the insurance payout. So what are we going to have here? Are you guys there? What are we going to have here? After we deduct, this is what we got from the insurance, and this is the tax value. So what are we going to have there? Are we there? What are we going to have there? Are you guys telling me that you don't know what you are going to have here on after we deduct tax value from the insurance payout? What are we going to have? Am I alone here? What are we going to have there?
Scrapping allowance.
No, it's a recoupment. Remember, we received 700,000 payout. Payout is just like selling price. The selling price is greater than the tax value. So which means it's a profit. A profit is the same as recoupment.
So the tax value, we are not deducting 700,000 to the tax value.
You know what you just have to figure out. Remember, we started calculating the tax value. So what you look at is the tax value is the carrying amount of this asset, and then this is the selling price. So the difference between if the selling price is higher than the tax value, then we are going to have a recoupment. That's all what you need to understand. This is the carrying amount of the asset, and this is the selling price of the asset or of the insurance payout, the amount they receive. So they receive 700 and the value of the asset is here. So which means they made a profit here, which is going to be our recoupment. I don't know if, so the recoupment is going to be 308. What is important is to understand when does it become a scraping allowance and what is this? This is the carrying amount, and what is this? This is the selling price. So if the selling price is greater than the carrying amount here, then it means we are going to have a recoupment. Right? I don't know if there is anything else there. So what are we going to do with our recoupment? Involuntary disposal. Involuntary disposal, section 8.4. So what are we going to do with section 8.4? Okay, so we are here. What we are going to do, remember we're going to use section 8.4. So which means here, you only take the recoupment equivalent to the capital allowance of the incoming machine. So which means we're going to take, this is brought new. So the recoupment that is going to be deferred is going to be, our deferred recoupment is going to be 40% times the recoupment that we have. You look at here, if there is a machine is going to be replaced, your recoupment, you don't check the full amount. You come here and check the replacing machine, was it new or old? If it is new, then you know you're going to use 40%. If it is old, then you know you're going to use 20%. So that's basically how you, but it's not all the assets. You look at involuntary disposal. Like people, if you see people replacing a machine, in some of the questions, you will see that this involuntary disposal can come as a result of the machine become obsolete, like, or the machine is no more like is behind technology. So in that case, you will be forced to sell that machine. So it's an involuntary disposal. So in that case, if there is an involuntary disposal, whatever recoupment that we have, we are not going to deduct the full amount. We deduct recoupment, the deferred recoupment is going to be 40%. times 380,000. How much are we going to deduct there? Times 40, which is going to be 152,000. So that's how you do it's a recoupment. It's not going to be deducted. It's an income, so there is no bracket here. It's an income. If it was a scrapping allowance, then we're going to deduct we're going to deduct it. Right? Then what do we do now? Anything that we still need to do there? What are we going to do? I think let's just scroll up and see. What is left here on our, I think there is a donation there. Yeah? Yeah, we still have that donation. Remember the donation that we have. So which means if we have a donation, then we are going to say so if we have a donation, we are going to have here, we should have taxable income before donation. So we can calculate this one. I don't think it's necessary to do the calculation now. So when we have our taxable income before donation, we now say less section 18A, donation. This figure will need it, the taxable income. Okay, so let's look at how much did we say is the donation. I think we have done it somewhere there. We say it's 2 times 130, 850, which is 261,700. So here we're having what? We're having 261,700. That's the donation. Then what do we do? Limited to 10% off. So which means we need this figure for the profit. What did we do with what did we do with the incoming machine? We didn't take into account the incoming machine there. Remember that machine was replaced by a new machine. We need the capital allowance for the new machine there. Here, we didn't take into account this. replaced machine with a new manufacturing machine costing 850,000, which was brought into use on 20 February 2024. So we need the capital allowance of that new machine, which is 850,000 times 40%. So we're going to have also a section toll allowance on new machine. So this one is going to be what? 805 times 850,000, sorry. Times, it was brought in new, which is going to be times 40%. How much are we going to get there? 340,000. So this is going to be a deduction. Then we need taxable income before donation. Then we can have our section 8. So let's have these figures. I think we need them because, but here, to be honest, on in your exam, this final figure, I always say, it's not possible for it to be the same. The reason why I want us to have the taxable income before donation is because remember, at the end of the day, we compare it with the 10% and the actual so that we can see which one are we going to deduct. That's the reason why we have to calculate the taxable income before donation. So let's calculate together. So there's 19,500,000 plus 2,640,000 minus plus what are we deducting? Sales, is it an income? Yes, it's an income. 67,200,000 plus 261 minus then we are now here. So let's subtract here. Rental is 450, so it's minus 450 minus 1650 minus 25,338 capital allowance of 50,000, right, minus 66667 minus 13333. Here, what are we going to minus? Minus 340 minus 340 plus 152 there's something that we must have left here. What is it that we left there? Anyone who can pick something on the manufacturing field. I see there's something missing there. Anyone who can pick something on the manufacturing machine. Sorry, the manufacturing machine here. Is this correct? The manufacturing machine. Remember, the question will come like this. They will do the calculation for the manufacturing machine, the wrong calculation. Then they will say identify when there is an error. So there is an error here on this question. What is it that we didn't include here? I just saw it now when we were calculating this figure. What is it that we didn't include on here? Anyone who can see what is not here on the manufacturing machine. There is no deduction for capital allowance for 2024. This 160 must also come to this side. I always forget to put this one on myself. I don't know why. So we have to subtract it against that 160,000. Right? So we now have our taxable income before donations, which is going to be 86, according to my calculations, 410, 462. This figure cannot be always the same. You can't have this same figure. It's not possible. So in your exam, you have to be careful not to come up with this, unless if it is correct, which is not also possible for it to be 100% correct. So every time when you are writing, make sure you check this figure. Double check and even make it different from others. But then it's going to be limited to 10% of 86, 410, 462. How much are we going to have there? It's going to be 8 million 641 046. So which one are we going to check here? This one. We limit to, you check the actual. Am I correct? 261,700. So what are we going to have at the end is going to be the taxable income. So we're going to have our taxable. So which is going to be minus 261 700. So it's going to be 83 million 7993 83 million why is it that? How did I do? I'm getting 8379. Something is not right with my figure. Okay, let me start from here. It's 86 410 462 minus 261 700. 1, 2, 3, 1, 2, 3. Yeah, so it's now 86, not 83. So it's going to be 86,148,762. So this is how you do your your question. Right. So this is how we so I would advise you guys to I will also I will also advise you to check, where is it, this thing here. I will check also on this one. Remember, we still have we're not very sure of here. We need to check. I'll check on my side. You can also check on your side, because I also want you guys to go and check the lease agreement, this one. So when we come to our next class, whatever you didn't understand on the lease agreement, when you check, you can bring it to our next class. Then before we start anything new, we can look at that list, because it's something that always comes and it carries a lot of marks. And what else is right? So we are done with this question. So what are we going to do in our next class? Are we going to have another question for business, or we can now go to individuals? Huh?
I see. I think everyone else, maybe they've, I don't know if they have left the class or.
Sorry?
I'm saying, I think it's just, maybe it's just two left.
Well, the others are no more there.
Yeah, I don't know what happened because I was also logged off. Then I have to log in again.
I think it's network, yeah.
Yeah, I think maybe it's the network.
Okay, so no, it's fine. I will check what we can do. But on your side, what do you think we should do? Do we have to do business taxation? Because what I was looking at is I wanted us to try to start with these long questions. Then after
Yeah.
these long questions, then we can go to the small questions in the question papers. But let us try to focus much on the long question. Then after we are done with business and individual long questions, then we can now try to look at the small questions like VAT. We can go through VAT. We can go through those small questions like donations. Yeah,
Okay.
and yeah, those small questions. But for now, I'm thinking if we can focus on the long, which carries a lot of marks, then if we understand those ones, then yeah, it will be fine.
Oh, okay. And I think for me that's fine as well.
Okay, so so which means in our next class, let's do a long question for individuals and see. I'll send the question in the group. We'll do a long question for individual. Because we still have the time, we can do individual. And when we are done, we can come back to other question for business until everyone get familiarized with what is happening. Then I think by the time when we are going to write, I think everyone will be fine.
Oh, okay.
Oh, so it means I was alone all along. I was asking and there's no one who was answering.
No, I think it just logged off now.
Okay.
Yes.
No, it's fine. So we'll meet
Oh,
tomorrow. If you are doing Meg, then it means we'll meet tomorrow again for Meg.
oh, okay. Oh, thank you.
Thank you.
Okay, bye.